Hello, everybody, and welcome. This is my Intermediate Accounting 17th edition video solution walkthrough. These are for exercises 23-5 and 23-6. This is from the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingett, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons, or Wiley. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. And this solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's do some accounting. Okay, so welcome. And so let's go ahead and get this started. So we've got here exercise 23-5 and exercise 23-6. And these are both asking us to prepare the operating activity section of the statement of cash flows. However, with, how should I put this? We're not doing the full statement. We're just going to be doing part of the statement. And so let's go to it. Now, the first thing I want to say is when we were being asked to prepare something using the direct method or the indirect method, the result is going to be the same. We're getting to cash flows from operating activities. However, as you are going through and looking at publicly traded companies, is that there is a huge value to looking at doing the indirect method. And I'm going to show you why. And it is because when we're doing the indirect method of preparing cash flows, we're taking net income and kind of working our way backwards to net cash from operations. Now, as we do this, right, and this is why it's so important to look at the indirect method, is that our net income was $7.4 billion for the 3 months ended March 31st, 2022. And as you see here, the net cash provided by operating activities was about 14 billion. And why is there such a difference between net income and here? It is because all the stuff that we've really, it's two big items here. It's share-based compensation, and it's also the depreciation. And these are both non-cash charges, meaning that we generally, with share-based compensation, we're going to be crediting additional paid-in capital. It's not really a liability. And depreciation is how we write off a prior purchase, right? We're basically not writing off, we're expensing it. So these are two big non-cash items. And when we're computing EBITDA, or earnings before interest, depreciation, and taxes, these are two items here that we need to kind of go through and add back. So when we do these questions, I like to do the indirect method first. So let's go ahead and do that indirect method. So what we do when we're doing the indirect method is we're going to first go through and set up our T accounts. So we're going to have over here accounts receivable in 2019 had a balance of 54,000. And then over here at a balance of 37,000 as of the end of 2020. Over here, we have, we've got accounts payable. Balance has a credit balance of 31,000. Ending balance here of 41,000. Then we have income taxes payable. And this had a beginning balance of 8,500 and an ending balance of 4,000. So here we've got, these are the three accounts we have right over here. And in addition, we're going to look at some other accounts as well. So when we're going through and doing, if we were doing a traditional question, this is we're only being asked to go through and do the operating section, but let's just go ahead and have some fun with this anyways. So right over here, net income. Where does net income typically go to? Now, one of the things you'll see when I'm doing cash flows is when I do this setup, and you'll see this on other videos that I have, is that I make a big cash T account. And the reason why I do this big cash T account is because this is how I like to do my cash flows. So I would have operating, investing, and then I would have financing. And the reason why I like to kind of go through and do it this way is because cash flows are one of the things that really troubles us as accountants. I've actually met accountants that don't know how to do this. So this is something we're going to teach you how to do it today, and it's going to be some fun. So, but in this particular example, when I would go through and do a cash flow statement, I would be analyzing the different balance sheet accounts. And over here, one of those accounts would be retained earnings. And although we're not given all of the information here, we are given that the fact that over here, that the company had net income, and the net income over here was $90,000. Now, what balance sheet does net income typically go into? It's going to go into retained earnings. And retained earnings is just a reminder over here. I've got my assets are equal to my liabilities plus my owner's equity, ER. I've got DC. And when I'm looking at retained earnings as an owner's equity account, what goes into retained earnings? I have my beginning retained earnings plus net income minus dividends. And this is going to give me my ending retained earnings. Now, what I like to do here is I'll say, well, net income was $90,000. And so what I'm going to do is I'm going to do the opposite to cash. So I'm going to come up over here and I'm going to say net income was $90,000, right? I'm doing the opposite to cash. Net income is going to be starting out as a positive or a debit balance to the cash account, because this is what we're going through and reconciling to net cash from, or basically cash provided by or used in operating activities. Now let's take a look at some of the other items. This other item right over here, depreciation expense. Well, if we had over here the 60,000, what T account would that be going into? Well, the T account that depreciation expense kind of goes into is going to be our accumulated depreciation. And when we have accumulated depreciation, just kind of remember the journal entry that generated this depreciation expense. I would debit depreciation expense and I would credit accumulated depreciation. And I'm doing this for a balance here of 60,000. Okay, so right over here, my accumulated depreciation would be credited here for 60,000. I do the opposite to cash. It's going to go in the operating section. And this is what we're going to call depreciation expense. So right over here, this is going to be a debit. I'm doing the opposite to cash. It's going to be a debit to depreciation expense. So again, we've got two items here so far. We've got our net income. We've got our depreciation expense. Now this question is giving this to us already. Right, we see that the depreciation expense, this is called that separately because it's a non-cash item. And of course, I could just go ahead and add it over here, but I always like doing it using the T accounts. And hypothetically, if we have this accumulated depreciation account, that's how we would go through and do it. So I've got now these two items. Let's take a look at our other income statement items. And I'm seeing over here a loss on the sale of equipment. Well, where does a loss, how does that loss on the sale of equipment happen? Well, when we sell equipment and we're going through and doing our cash flows, this is what I would recommend that you do. You write up a journal entry that we always go through and use when we sell equipment: loss, balancing. We also will be getting cash, we'll be debiting accumulated depreciation, and I'm going to credit equipment. And I'll have a gain and balancing. Now you might be going, Tchaikovsky, what the heck is going on here? What are you doing? Great question. When I sell equipment, I have to take that equipment off of my books. So I'm going to basically be crediting equipment. Also, when I sell equipment, I have to get rid of that accumulated depreciation. That is a contra asset account. It's going to have a credit balance. So I'm going to go ahead and debit that balance. I'm going to get cash, and then whatever I have over here left is going to be a loss or a gain. Now, the rule is when I sell equipment and I'm doing cash flows, at least my rule is I take what I put in there and then I post it directly to the T accounts. So right over here, the cash that I would receive would go into the investing activities. And the loss, which is right over here, loss on sale of equipment of 26,000, this would go into my cash section here, a loss on sale of equipment, and this would be for $26,000. So losses, I'm going to be adding those back. Loss on a sale of an investment or of equipment, that's going to go into my operating section. So that kind of takes us through all of these items here in terms of what we need to go through and do and reconcile for the operating activities section. Now let's go through and take a look at our other T accounts. Now, The reason why I use T accounts for this is you'll see this if I'm looking here as I say, oh, I went for 54 to 37. What do I need to do to balance? Well, I'm going to need over here, I'm going to need a credit for 17,000. So I'm going to do the opposite to cash. I'm going to debit cash. And when I describe on the statement of cash flows where this is coming from, this is going to be a decrease in accounts receivable. Remember, accounts receivable is an asset. I show in an increase with the debit, decrease with the credit. Here, my accounts receivable is decreasing, right? This is a very, very important thing to remind ourselves of. If you ever get an accounting question on an interview, great thing to go through and look at. Accounts receivable is an asset. I show the increase with the debit, decrease with the credit. What I do here is I'm doing the opposite to cash. So I'm going to debit cash, but when it comes over here to AR, what I'm going to go through and do and the way I'm describing it, I'm going to describe it what's happening. It's decreasing. Accounts payable. Accounts payable was at 31, went to 41. To balance it, I need a credit of 10. I do the opposite to cash, or I'm going to go ahead and debit this for 10,000. And what is happening with accounts payable? My accounts payable is increasing, right? Accounts payable is a liability. I increase it with a credit, decrease it with a debit. So this is going to be an increase in accounts payable. Now, for income taxes payable, well, what do I need to do to balance? Well, it went from 8,500 to 4,000. So this is going to be decreasing by 4,500. So over here, I'm going to show this as a credit. So over here, when I go through and do this, I've got this over here of 4,500, and this is going to be a decrease in income taxes payable. Okay, so now what we're going to go through and do is we're going to go ahead and add up our totals, right? So I'm going to look here at my total debits, my total credits. Over here, I have total debits of 203,000, total credits of 4,500. When I subtract the smaller value from the larger value, I'm going to leave the remainder on the larger side. And what I'm going to call this is, because it is a debit, this is going to be net cash provided by operating activities. Okay, so this is how I go through and do this using T accounts. Let's go ahead and put this over here. So if I was doing a statement of cash flows under the indirect method, what I'm going to go ahead over here and do is I'm going to go ahead and say, all right, indirect method, cash flows from operating activities. We're going to have over here net income. Now, if I was going to be really fancy, right? If we're going to be fancy pants, adjustments to reconcile net income to net cash provided by operating activities. But really for here, we'll just go ahead net income. And if it's a debit on the T account, I'm just going to show this as a positive amount. So I'm going to go over here and oh boy, there we go. Depreciation expense, loss on sale of equipment. And what we're going to do here is I'm just going to go ahead and pull these numbers down. Now, all of these are going to be positive amounts on the statement of cash flows, right? But if it's a credit, this is going to show as a negative amount on the actual statement of cash flows. And if we take a look over here, we kind of see accounts receivable. So accounts receivable, because this is positive, accounts receivable more than likely decreased, right? So if I look at it, accounts receivable went from 14 to 11. So that's why that's showing up as a positive number on over here. So my total, my net cash provided by operating activities is going to be over here at 198,500. Now, the reason why I went through and did the indirect method first is because in my career, I have only prepared the direct method for, oh boy, you guessed it, probably the CPA exam. A lot of companies, and I love it when I challenge students. I had a great student at Chapman who said, oh, Tchaikovsky, you said we couldn't find it. And I think she was like Walgreens or CVS. But I don't like you. I believe you still have to show the indirect method as a supplemental schedule if you choose to use the direct method. But we know that this is going to have to be our answer when we're going through and doing the direct method. So let's go ahead and do the direct method. Now, what you're going to notice here is that we're taking with the direct method is I'm taking I'm going to take the big accounts. I'm going to take services revenue. I'm going to take operating expenses. And I'm also going to be taking a look at over here, my income tax expense. So I'm taking the big expenses. And what I'm going to do is I'm going to convert these to cash received from revenues, cash paid for expenses, for operating expenses, and then cash paid for income taxes. And the way I'm going to go through and convert it is by looking at what's happening in the account. So let's go through ahead and do this, right? So we know, though, that the magic number that we need to get through for the direct method is going to be 198.5. So if you have a professor that's making you do this, my best advice to you is say, Professor, will you please show me a publicly traded company that uses the direct method? And just say, I went to Meta Platforms, I went to Snap, I can't find it. I could find Nets, Crackle, and Pop, but just tell me, help me out. So over here, our services revenue is going to be 840,000, a positive amount. Now, what I'm trying to do is I'm trying to look at this in terms of getting what was my actual cash from sales. Now, since over here, since my accounts receivable decreased, right, by the 17,000, basically the change plus my decrease in accounts receivable. And why am I showing this as a decrease? Well, if my services revenue were here at 840 and my accounts receivable went down, that means I must have collected more money. Think about it. I debited cash, credited AR. So this is going to be 17,000. So my cash from sales is going to be $857,000. Now let's look at the next one over here. So my operating expenses were a negative 624,000, right? That's what I would have to go through, and it's going to show up as a negative amount. Now, over here, when I look at accounts payable, well, accounts payable, this is kind of like we borrowed more money, right? So when I'm going through and looking at this over here, my cash isn't really going down, right? But it's actually going the opposite way. So right over here, I'm going to show this as an increase in accounts payable. And over here, this is going to be 10,000. Now I'm thinking we're kind of getting close to doing a rule. If we look at the T account and the amount as a credit, we're going to go ahead and basically add the amount to either a negative or a positive amount. So my cash paid for operating expenses is going to be over here at 614. Now, you might think of this as being a little counterintuitive, but right over here, if my AP is going up, it means I didn't pay for part of these operating expenses. So therefore, I'm adding that amount back. Now, the next one over here is going to be income tax expense. Now, with this income tax expense, it's a negative 40,000. And what I'm trying to convert this to is going to be, what is my cash paid for income taxes? So what I'm going to do here is I'm going to say, well, this is 40,000. And let's take a look at income taxes payable. Well, income taxes payable decreased, right? It went down. So that means I paid more cash for my income taxes. So we're going to go ahead and make this for 4,500. Now, we're going to hope and pray. We're going to do a lot of things like that. We're going to go get the magic 8-ball, which we can't use during the CPA exam, but we're going to do something here with tarot cards or something else like that. So this is my cash paid for income taxes. When I add up these three amounts, boy, hopefully we're right. Cash from sales, cash paid for operating expenses, cash paid for income taxes, and I get what? Oh my goodness, thank goodness. Oh my goodness, thank God. I get 198.5. Oh, is that the same number I got on the indirect method? The answer is yes. The presentation is different. And I will say this, I do not like this presentation because when I am going through financial statements, to me, this is so important that I know these non-cash items, because when I'm going through and doing financial statement analysis, this is probably some of the most useful information for me. So that is exercise 23.5 and exercise 23.6. So I hope you enjoyed it. Hopefully no one was hurt in the making of this video. And I look forward to seeing you on the next video. Have a great day. Oh, and I want to thank you. Oh, where did I mess up? Oh my God, Tchaikovsky, you're losing it. I want to thank Wiley. Please don't forget to like and subscribe. And if you'd like to see other solutions, please ask for them in the comments. I'll see you soon.